The stock market, like any other financial market, is a place where you can buy and sell assets, in this case, shares of a company. Like anything that is being bought and sold, stocks are subject to the law of supply and demand. When the number of people who want to buy them increases, the price will go up, and vice versa. Some of the major stock exchanges worldwide are the New York Stock Exchange, NYSE, NASDAQ, the London Stock Exchange, LSE, Tokyo Stock Exchange, Shanghai Stock Exchange. Markets have different indices that indicate whether prices are rising or falling, e.g. S&P 500 Index, Dow Jones Index, FTSE. People engage in buying and selling financial assets based on their expectations for future prices. In forming expectations, a trader should perform analysis of the financial asset or instrument he wishes to trade. The analysis includes three broad categories: fundamental analysis, the analysis of real-world factors that affect asset prices; technical analysis, the analysis of charts and price movement that affects price; econometric analysis, the analysis of statistical relationships that affect asset prices. In order for your analysis to be helpful and trustworthy, it should be detailed and synchronized between the technical, the fundamental, and the econometric part. We will have an extensive focus on all of these categories throughout our manuals. As a starting point, we present you the principles of fundamental analysis. Fundamental analysis is an assessment of real-world factors that influence asset prices. Fundamental analysis is widely used by prominent investors around the globe, such as Warren Buffett. The ultimate goal of fundamental analysis is to arrive at a prediction of the fair future value of assets. A well-performed fundamental analysis helps investors achieve maximum profit at a minimum level of risk. Fundamental analysis can be divided into three stages: macro-environment analysis, micro-environment or market analysis, and asset-specific analysis. We live in an increasingly interconnected and dynamic world. Therefore, before making an investment decision about any stock, bond, commodity or currency, it is essential that a comprehensive analysis of all major macroeconomic, political, and social trends that affect financial markets be made. How to conduct macroenvironment analysis. Use a systematized framework such as PESTLE. PESTLE represents an instrument for analyzing trends that reflect the development of various macroenvironment phenomena. The factors that the PESTLE framework helps us analyze are political stability, form of government, degree of corruption, etc. Economic, exchange rate, interest rate, inflation, economic growth, etc. Social, population growth, population aging, immigration patterns, etc. Technological innovations, inventions, etc. Environmental, air pollution, climate change, etc. Legal, regulations in commercial law, consumer law, etc. In order to be fully prepared for making profit on the market, a trader needs to complement its macroenvironment analysis by conducting additional, more narrowly focused analysis. Microenvironmental analysis, also called market analysis, goes one layer deeper in exploring the drivers behind assets' price movement. Its goal is to reveal tendencies specific to a narrower scope and set of events. The factors that microenvironment analysis investigates vary according to the asset type we aim to analyze. The analysis for stocks is different from the analysis for bonds. When analyzing stocks, one of the most widely used approaches for microenvironment analysis is Porter's 5 Forces model. Porter's 5 Forces model, as its name suggests, analyzes 5 aspects that influence the performance of a company, hence the price of its stocks. Porter's 5 Forces is designed to analyze the following factors: threat of new entrants and entry barriers. The higher the barriers to future competitors, the better for the future stock price of the company. Threat of substitute products. The lower the threat of substitutes, the better for the company and its stock. Bargaining power of buyers. The less buyers can influence the decisions of the company, the better for the company and its stock. Bargaining power of suppliers. The less suppliers can influence the decisions of the company, the better for the company and its stock. Intensity of industry rivalry. The lower the rivalry, the better for the company and its stock. Asset-specific analysis is the most focused step of fundamental analysis. It investigates factors and indicators that are narrowly specific to a given asset. it is a must to examine the following features of the asset you wish to invest in: asset specifics, where the asset is traded, and what the commission fees are; historical prices, how the price has behaved in the past; price volatility, how much has the price fluctuated in the past; relevant risks, what specific sub-risks are relevant for this asset.